we're in a bit of a corrective phase in the market, and a lot of that is over worry about the Fed and what they may or may not be doing with interest rates at their September meeting. So I want to go over that briefly. I don't want to spend too much time on it. I think most of you know how I feel about the Fed and their prospects for raising interest rates. Ad infinitum, this is discussed on TV all day. Will they, won't they? Will the Fed raise interest rates? As of right now, the probability of a September rate hike is 15%. I've heard people say, oh, it's going to be 50%, it's going to be a third, whatever. It's 15%. That's what's being priced in. As of right now, December is being factored in at a little under 40%. We have some big economic data. Just as a side note, I think it's very unhealthy what the Fed is doing, that they have everyone on eggshells with regard to what they will or won't do off of small points of data. Really what the Fed, in my view, and what I don't think they'll openly say this, but what they need to do is to see a trend of improvement. And if anything, we've been seeing a trend, but it has been of data weakening, getting worse. So the Fed would technically be hiking interest rates into a weakening economy. They have done this before, last December. Historically, the last 2 to 3 years, I believe, have seen very weak first quarters. So keep that in mind. My theory on why the Fed won't want to hike interest rates so quickly is this. They've been wrong on their growth rate projections for some time now. They had said that they were, first of all, expecting possibly 4 interest rate hikes this year, and the data has definitely not supported that. They have now been wrong for the first half of the year, so they're counting on kind of the gambler's fallacy of double up to catch up. And for them to hike now, they would be basically stepping on their ability to make their numbers. Anyway, that's my view on that situation. Is the connection okay? I'm seeing some complaints about the connection. Can everybody hear? Let's see. Yeah, it's good? Okay. All right, I'm glad we got that all cleared up. Anyhow, so that's my take on basically on the Fed. I think they're on hold. I think that they have made it. The problem, I think, for business and the economy is that there hasn't been a lot of certainty in terms of policy. If anything, government policy has been very anti-business, and the Fed has sort of been the only game in town, and Stan Fisher has said that himself. It seems to me that they would want to have more certainty in that, but they are not. They are basically day trading the numbers publicly. I don't think they're doing it so much privately, but I think their goal is to kind of keep a lid on the stock market so there isn't some kind of blow off top. And their way of doing that, they can't obviously do very much in terms of real policy terms, so they do it with their mouths. They jawbone the market. They create this fear of interest rate hikes, and that keeps a lid on the market. They need to be a little bit careful, I think, of what they wish for, because one of these days, one of these corrections might just get a little bit out of control. So we have a lot of data tomorrow. This is what I'm going to be looking at. I'm going to read through for you what the data is, and then I'm going to basically say which ones I think are important. So we have jobless claims at 8:30, clearly important. PPI, that's important. Retail sales is a little important. We have a Philly Fed business outlook, that's always important. The Empire State Manufacturing Survey is a little less important, but one I'm looking at because the manufacturing has been where the real pain has been lately, so I want to kind of get an idea of that. The Philly Fed, and why am I drawing a blank? I think, and the ISMs, the manufacturing ISM is really key. I'm looking for some continuity in that. Current account doesn't really matter for our purposes that much. Industrial production, that's always interesting. There was one more that I wanted to mention. Industrial production, business inventories. That is one that I don't think goes as it's a little bit of something a little more esoteric, I think, for most traders. but I'm looking to see if there is a build or a drawdown in those inventories, because we've been seeing huge contractions in inventory builds. So I'm curious to see where their heads are with how they're stocking their inventories. That could be an interesting read for the fourth quarter. Anyway, we're in a bit of a treacherous situation with regard to the S&P, and I'll talk about why. So we all know that we had been in a very tight consolidation range up until, I believe it was last Friday, 9/9, where we had this big kind of breakdown in range, and I view it as more as a larger liquidation break. I had been talking about there being a confluence. For the last 2 weeks before that, I had been talking about a confluence of poor highs, and that I thought that could lead to a larger liquidation break, and that's what we're getting here. The reason we're in a bit of a treacherous situation is this: that once we get through the rate hike that I don't see the rate hike I don't see coming in September, the euphoria of that is the jubilation of that won't be short-lived, and we're going to immediately then focus on December. So even though the Fed might not go in September, there is still going to be the overhang, the loom of the December hike, which is not good. So where are we in terms of technicals? So we had the big breakdown on Friday. We had the big rally back on Monday. I think the reason for the rally back on Monday was you had overnight inventory already heavily short on Friday, and then they overly pressed it into the close, and then you had basically a gap down. So you had very stretched inventory, and you needed a bit of a rebalance. Also, the market had just knifed through the 50 MA kind of like it was butter. So this was just basically a bit of a failed retest. Yesterday, we had a gap down that wound up being weak. Didn't take out that Monday low, though. And then today was a bit of a failed rally attempt. So the way I see it is there are kind of three scenarios here. I guess four scenarios. The first being the most obvious, that we could continue to just chop sideways. The second one would be a failure, meaning we lose those lows and we continue lower. You have to be on guard for a potential look below and fail, meaning it goes below and doesn't follow through and comes back to the upside, or a look below and go where it continues to go down. So those are the other two scenarios. And then the last one is one I don't think a lot of people are considering, but we must consider, is a move back up. And that move would take it over yesterday's high. Why is that a key level? Because that was, if you're short here, shorts tend to have more discipline than longs, just the types of traders they are, and they tend to trail down their stops. And if you're short, you probably now have moved your stop to, in SPY, 115, anything over 115.15. That was yesterday's high of day. I think if you were able to take out the 2-day consolidation, these today and yesterday, through those highs, I think the move would be back to the upside. There's a little bit of, so where would we go in terms of price? If the move is down, I see we have the 100 MA right below us, but because we stopped right there and we've kind of just been hovering above it, I don't know how much more support that would give. We're currently holding an important level. The real breakout levels here were 212.52 to 213.78, and while we're a little below the 213.78, we're still basically holding the 212.52. It's a lot less technical damage than I think people believe it is. Yes, we do have, it is a down move, but it is into some supports. The good news is that even a still further break, there's a lot of muscle memory just below us. There's a 50% fib of the entire the range from the Brexit low to this recent high, which comes in around 209.13. There's a gap fill there, also at 209.53. And I don't think I have to remind anybody here about how much trouble clearing 210 to 211 was. That should now act as support. So there might still be some more down move here, but that down move might not have as much legs as people are kind of hoping for. So if you're not really already in the short, you might not be getting as much bang for your buck. If there were to be some type of an overshoot, the levels then that I would be targeting would be roughly around 206s. That measured move comes into play roughly around where the 61.8 is. If you took the Brexit measured move from that range high, the 250, or I should really say that I forgot where I did this from. If it was from the Brexit high to the low, or if it was from the 212.52 to the Brexit low, but that would roughly take you into the close to the 200-day moving average, which is currently around 205.83. I have that move marked off at 205.73. And you have a 61.8 of the move of 206.65. So if there is a overshoot, like if the channel doesn't hold and there's something of a larger break, that's where I'd be targeting. So that could be a more significant move. As of right now, the thesis for me is that the 209.53 to like the 211 area should be some support, particularly down near that gap fill 209.53 to 210, because that 210 to me was the really the hard level to break out. We had a lot of, if you go back a few months, we had a lot of Friday closes and options pinning around 210. I think there's a ton of muscle memory around there, so that level to me is particularly key. So if there were to be a break now of the 3-day low, I think that you would be looking to target that area. I would like to do that either with outright short SPY, via SPY call spreads, or via SPY put ratios. Keep in mind, though, we have to always be on guard for the right or right out play. Like if it's a look below and fail and we come back up, that move could move a lot more than you might realize. So the break for me would be the right or right out short below the 3-day low, and then the right or right out long above the 2-day consolidation high here, which would trigger it around 215.16. So we're going to have, that's the way to play it in my view. A couple of things here that are lining up interestingly is, first of all, IWM is right around, today basically was a fail on the backside of the 50-day moving average, but the reference high breakout was 120.58, and we closed just above there. This is a game of pennies sometimes, and it's still kind of like all right as long as that holds. If you lose the 2-day low, however, I'm thinking we could then see the 118.89, which is an old reference level, and more importantly, the channel low. And if you've been watching me for a while, you know this level. 117.37. That's been a very key level in IWM for a while. So the same type of a situation here. If you take out the 3-day high in IWM, I think the trade is back to the upside. If you're to take out the 2-day lows, then I think you can start targeting those levels down near the channel low. Keep in mind, the market is now coming off of an all-time high and still in an uptrend channel support. So we're not in a bear market yet. There is no trend breaks here. So this is all pullback within the context of an up market still. Keep that in mind. Until that changes, I have to always assume, until the trend changes, I always assume it's intact, if that makes sense. So that's key. One of the things that is the outlier here is the Nasdaq. That is showing tremendous amounts of relative strength, and I think we all know why. It's basically Apple has been bossing it up. So where does that situation lie? Today, believe it or not, we almost broke into the gap. I think it was like maybe a tick lower. The high of day, I'm sorry, it was a few ticks lower. To break into that gap area, you need to get over the 116.51, and today's high of day was 116.47. And we closed still above the 50-day moving average. And we closed above the old reference high of the breakout, which is still 115.75. Today we closed at 115.84. So there's no bear market in the Nasdaq, not even close. If this were to break down, the fall would be considerably more. The 100 MA doesn't even come into play until the 111. So if you were to break, I like for a trade, I'm sorry, we're starting to get into allergy season here. If we were to break the 2-day consolidate, believe it or not, the 3-day consolidation low is even down at 113s. I don't know if I'd wait that long. I would use yesterday's low and the breach of the 50 MA as a short point below 114.73. And if that were to break, I'd be targeting 111s. And if things get kind of cray, I don't know if they're going to get cray, but if they are to get cray, then I'm thinking we could see maybe the 109s. That's trend, and that's also roughly a 50% fib. There are a lot of high peaks around there. There was the one at 111.44, and then there's one at 110.75. I find it really hard to believe that this is just going to completely collapse given the strength in Apple, which probably should hold here. If Apple were to pull back, 109, what was the, I don't want to cuff it, 109.85 to 109.79, between, let's say, 109.79 to, why do I have 109.79? I don't even know why it's not the correct level. Scratch the 109.79. I don't. Oh, that was an intraday level. I'm sorry. We could just ignore that. I'm sorry. I'm going to give you the right level here. The key hold is 109.85 to 110.23. If there's weakness, it would not surprise me to see some type of 110 pin, but that was the breakout. Apple today tagged over the 112.39, which was the last kind of peak high before the last drawdown. I would say that if you can clear that high and the 113.03, then my next target there would be the channel high that we're in, roughly around 115, if it were to happen tomorrow, 115.28. I think longer term, Apple may want to get back up to like 119.75, 120. I don't want to make the call that it gets back to 125, but I think it's possible that she can get back to 119.75. Keep in mind the conditions we're in under Apple here. We know that their pre-orders are good because Sprint and T-Mobile said, I think Sprint, T-Mobile, and AT&T said they were good. Verizon kind of was a little more cagey. They said that they were roughly on pace. So that's good. We also know that Tim Cook has come out and they've reaffirmed the quarter, so we don't really have to worry about so much of a miss in Apple. So I think the play, believe it or not, could be some type of a squeeze into their earnings higher. If that were not to happen and we were to get some kind of a flush, that would be like a gift and a huge setup. Because we know that they've already reaffirmed the quarter, and it would seem very ridiculous to me that they would then miss it. I mean, that would destroy the credibility of Apple's management team, which I really don't think they're looking to do here. So Apple to me seems like it probably wants to grind sideways to higher. On pullbacks, I like selling out of the money puts, even though the volatility isn't that great. You could maybe look a little longer out, closer to their earnings. You'll know because those will be the IVs and the 26s pluses. Don't sell IV that's below then unless you want to take shares on some type of a pullback and you just don't want to pay the high of day. You know, that's my view. If short term you want shares and you want to do it kind of the, you want to be put into it, fine. If you're only looking to be a premium seller, go out to where you know the premium is at least fair. That'll probably continue higher though, maybe into the low 30s. But it won't be as big of a jump like it is from the low 20s to the low 30s. At least this way you're in the mid 20s, potentially into the low 30s, but you might just have price on your side. Out of those strikes, I would like 1.5 and below. There was a lot of support in that area. If you've got the huevos rancheros, so to speak, you can use like 107s, 108s, because that's really where this kind of gap got going. If the Apple were to fill that gap, it's like 105s. That's why I initially mentioned that level. So between 105s and 107s, I like strikes below there. If you're, if you're willing, you could even do the 110s, but I usually like to give it a little wiggle room, particularly with Apple. The BABA. So this BABA is acting really well. They had a great quarter. I know Jim Chanos is short the stock and he hates it, and That guy must be some character to be around. All of these short sellers, I just can't. I'd love to meet them and just like know what their personalities are like in real life. I mean, to always think the negative of everything. I mean, I don't know. Anyway, as long as this stock can hold over the breakout range, and we did have a look below and fail, we actually, and I'm just noticing this, and I'm a little upset with myself for just noticing this, have a secure low situation here at 97. We had that was on the 9/12. You had a low the prior day, the low which came back up, and then the next day was basically an equal low to the day prior, and then we're now up over those highs. So as long as we're above the 101.38, I think it's kind of game on. If we now start getting back below like 98.35 to 99, something is wrong. It shouldn't be back down there again so soon, and I'd likely use that as a stop out. I'm currently in a risk reversal call spread, meaning I'll give you the strikes. What am I long? 128 days to expiration, long the 100s, short the 120s, and in, which one is this? In 65 DTE, this was a roll-up. I had been short other puts. I think I was short 85s, and now I'm short 90s in November. So that's how I'm playing it. If we were to come back below, I would take the hit on those puts and just get out of the situation and just kind of chalk it up to, you know, just bad luck here, because it didn't hold where it should have held. I shouldn't use the word luck. I never really like to say it's in there, but just bad, a bad situation. Like the market isn't cooperating with the stock. For stocks to rally, you usually need some market cooperation. But right now, the BABA looks okay to me, and I am playing it long. Let's go through this. So some people are asking about some stocks here. I'm going to go through the ones that I know instantly, so we can just get them done quickly. Tesla. All right, so we're coming into some reference lows. 190 to 191 is a big level, and we're roughly fumbling around that area. We got as low as 193s. The ideal scenario would have been for me, I'm sorry it kind of bounced here. What I would have liked to have seen was this to have come right into the last reference low and then have a rally back up. I am not so keen on Tesla as long as it's below, and I said this, the minute it broke the 200 MA, that was Gonzi's for me. This could rally back up to the 200 MA, and I do think that that is going to happen at some point. That's roughly around the 216s now. So short term, I like buying Tesla for a bounce play back into the 216s, but I have to say that I will be trying right or right out short versus that 200 MA, at least for a day trade. Longer term here, I think the problem was with Tesla, or the problem is with Tesla, is that the shorts know they have to issue new stock, and until that equity issue is out of the way, it's going to weigh on the stock they're not going to cover. I think they're going to wind up getting their, what's banged in the door here, but that could take a while until they do the equity offering. I think the mistake Musk made was when he mentioned that they need to do a small equity offering, he should have done it, not waited and have this overhang over the stock. If you mention there's an equity offering, you do it. It's sort of like pulling your gun in a fight, right? If you pull your gun, you shoot. He didn't shoot, and now the shorts are laying into the stock, so that's the problem. So that's Tesla. Chipotle. All right, so this is setting up interestingly. We're through the 100 MA. It's right on the 50 MA here. This is the problem with Chipotle. It needs to be over the 100 MA, and it's now below the 100 MA. If you want to try right or right out long, I like it against the 50 here, which is just below us at 114.90. So if you want to try Chipotle, you could try a right or right out trade against the 50. Any close below the 50, and it's Gonski's. I would look to do an add on that trade back over the 100 MA. Then if that can hold, then you could start really playing kind of with maybe some more size. But the stock is very iffy. It's just been choppy. I don't want to say it has poor lows, so if there is some type of a move on earnings, it could be really super duper violent. I would probably be looking for the ideal scenario for this, and I know this is not what a lot of people like to hear, but this would be, we just got from the top end of range, the ideal scenario for earnings setup would be to continue to sell off down below, even below that range, suck in all the shorts, and then boom, back to the upside. I'd be looking for, if there's some type of a breakdown here ahead of earnings, I'll use that for a right. I would do it with options. There's no way I would do it with the stock, but I would be playing long there for the earnings. If they do something like rally it into the earnings, then I think it could set up for a right or right out. I shouldn't even say right or right out because on the earnings you'll be in the stock, but I would do it with options and play short. So it's going to be a George Costanza situation in my view here. If they sell it hard ahead of the print. Actually, let's back up 1 minute. Short-term time frame, I like it against the 50 here for a right or right out play. Bigger picture now we're talking. I like the idea of it selling off through the lows, sucking in everyone, getting out all the longs, and then playing with options for a trade to the upside. If it rallies into the print, then I like the idea of playing it for potentially a short. So with risk defined with options, of course. So that's my thinking right now on Chipotle. I'd be happy to revisit that, however, when we got closer to, and I've seen more kind of trades. I like to see how something trades. Twitter. All right, so we got to the channel high, and now we're near the channel low, and near a 50% fib. My feeling on this is that I don't want to say that the company has seen the worst. Their management is really slow. I could have used some stronger language, which I've scorched them with before. The words of like incompetent come to mind, but I'm going to keep it a little bit more friendly today. I think people who are playing this for a takeover are dreaming. It could happen at some point. Twitter could be a takeover, but the way that they're managing this company, it would probably be a take under. I think they're going to kind of have to dig themselves out of this hole themselves. And from 2 earnings calls ago, they announced that they were going to start expanding their character counts and not counting hyperlinks, and they have yet to do it. I mean, Twitter to me, I mean, the other day on my iPhone, I got an update, and it said that Twitter had to update. The app had to update, and they put in the caption. They say what they're going to do. It says just like minor fixes and improvements or whatever. And I just wanted to slam my phone down in frustration because these people are just not innovating. I mean, it's absolutely incredible. I don't know what they're waiting for. Maybe they're looking to do some kind of like a bigger relaunch of the platform. That could be the case. But it would be nice if they said that, at least. I mean, oh, God, it's just a terrible execution. A few months ago, it's already a while ago, they had hired a diversity director, and I scorched them for that. It's like, innovate. Don't worry about, how diverse your company is. I mean, just, get the effing thing done. It's just really frustrating. That being said, we're right near a channel low. I like the last swing low as a right or right out play. Either long versus a 17, let's say half-ish, 17 half to 1740 stop, or a violation of that. I think you could play down to 1680s or whatever for a quickie down to the 100 MA, or the 61.8, which is around 1654. Right now, we're holding the 200 and stalled over the 50. So I think a move over today's high of day would probably be a long. And then below that, like I said, that last low, that Tuesday, yesterday's low, would be a right or right out short. Simple. I don't think the property, by the way, is that expensive. I think Twitter is a very unique property who would benefit tremendously from new management. Google has never really gotten social right other than YouTube, which they bought. Their Google, it was like Google Plus or whatever, is a bust. I don't know. I don't know anything they should really buy Twitter, in my view. Apple or someone should buy them. Someone who doesn't have social. Microsoft. One of these big companies that missed. Well, Apple didn't obviously miss mobile, but they really haven't done anything with social. But one of these companies that doesn't have a social component that has been successful, like a Microsoft, like a Google, like an Apple, should lay into this or do some type of a partnership, in my view. I think that any management team other than the one that they currently have will do better with their property. On a side note, I don't like what they're doing with booting people out. What they did with that guy who, from the I think it was from The Verge or from, I forget what was he from? That Nero, at Nero. There was that whole thing with that lady from Ghostbusters or whatever. I didn't like what they did with that. I thought that they handled that very poorly. Let me take a look at some of this stuff. Someone asked me about this Autodesk. I don't follow this company very, very often, so I'm going to do this one on the fly for you. They made a new high. It's pulling back a bit. Let's just throw a trend line in there. I'm doing this one on the fly. So there we go. Let's throw in a price level, a breakout area. We're currently a little bit below the breakout. There's another breakout point or reference high at 62.42. And let's throw the Fibonacci on it. So I think what happened here, this moved up a lot. This came up from the lows now and ran the stop on the highs. I would think here it's probably going to pull back a bit. You're a long way from Kansas Toto with this one. I got to adjust this here. Sorry, 4160. So I don't use 38s. We'll take that out. The 50% fib and the trend line is down at 55s. I don't know if it's going to get that low, but I would be more interested in this thing if it were to pull back. Did they report yet? Yeah, this was the big bar. All right, so they report. We have an earnings bar. I'm going to keep it really, really simple with this one. If it can hold 65.06, which is the low of day of that bar. This to me looks, just so you know, more of like an exhaustion gap than a professional gap. So, and it has a double top in here. I think lower. I could be wrong. Like I said, I don't follow this one that often, but this to me looked like if I were long this and I had been holding and it got over the last high and then gapped, I'd be selling it too. If it gets back up above 69.21, given the fact that you now have a double top in there, then it will go higher. If it goes below 65.06, it's probably going to fill the gap and then maybe even get to the 50 or 100 MA. So that's my take on Autodesk. That to me looks like a more of an exhaustion gap than a professional gap. If you're curious what that means, I have a video on YouTube with that analysis. All right, I'm looking at this. Someone asked me about this stock, this Fizz, not one I don't think I've even heard of this company. I tend to trade in like the more leading stocks, not the ones that I don't like, these that I don't know. It looks like it broke trend a couple of sessions ago. It held the 200 MA twice. It broke the downtrend, and now it's currently struggling with the 50-day moving average, which is downward sloping. That's where the breakdown took place from, and that's where the last couple of checkbacks have taken place. You need to clear the 50 MA here. If anything, the last couple of sessions here to me look like almost like a secure high. If you were to break below 51.28, I think it's a short. If you can get back up above 54.84 and the 50 MA, then I think you probably retest the all-time high in the stock. So that's just my take on this Fizz. I'm actually going to start. I'm curious to see how that plays out. Back to the rivers and the lakes that we're used to with Shake Shack. Shack is coming back down into some reference lows. I kind of like to buy it down here and then put it back out when it gets higher. It is below, kind of below trend. It's into some reference levels. So for me, what I usually do with this is I sell some out of the money puts, and either I take the shares and then pump them back out higher, or I usually make the money on just the puts expiring. It's sold off a lot. It's coming into the reference area. So yeah, I like selling out of the money puts here, like 32 strikes or below. If you've got a little bit more gumption, you could even sell some at the monies here. Longer term, I like Shack. I think it just is going to take some time to grow into their multiple. The best thing that Shack has going for it is that everyone hates it. That's my take. Yelp. This was one that I liked. I'd like to say that I was in it at the dead lows, but I wasn't. I got into it more like in the 20s, and I pumped it back out when it got higher. So I haven't really been in Yelp for a little while. It has gone further than I had expected. My target really was into the 32s, and now it's up a lot more. That was really the last gap fill, and a reference high. Stock looks okay. It looks like it's consolidating and pulling back. If you're long, as long as it's above 35.72, it's okay. And as a stop, but I wouldn't be initiating longs in this unless it can clear. It's got to be over 37.57. That was the earnings gap, kind of high of day. And the 10. I like it back over the 10-day. I'm a little iffy about it here. I selfishly would like it to pull back more so that I could kind of buy back into it. It broke out above the channel. It's now kind of hugging the channel high. If this were to fill back, I guess, down, fill the gap again, I'd be more interested again. I do think that it could get back up to 41s though, but it's starting to, the risk reward is not as good as it was when I was liking it, back when the company was, valued basically at a $2 billion company, which I thought was a complete joke for the value of the brand. I know a lot of people think it's a commodity. It's real. People use it. It's a fantastic app. I suggest people get into it. The gap and go was over the 200 MA. At some point, I don't know when, I do think the 200 will come up. I do think we're going to get a 200 test. I'd be all over that. But for right now, as long as it's holding the 50 MA, the 50 MA on pullbacks, I like buying a 50 MA for right or right out. But I do think that the upside is getting a little limited here. The air is getting a little rare. So unless there's a takeout, which is very possible, it's probably going to start running into some problems up closer to the 41. So I'd be looking to book profits on rallies, and then maybe be looking to sell some puts or BTD, buy the dips on some dips. Yeah. Oil. I'm really all over the place right now. Oil is just kind of consolidating and chopping. It's weird. They had this really great inventory number, and then today there was supposed to be a bit of a build, and it was a bigger than expected drawdown. The price action wasn't that good. I think that's because the companies are hedging with oil futures out in the future. Trend, and the really key area for me is 42.49. As long as oil can hold over there, it's quote unquote okay. If it starts losing that area, we're going to probably see the 200 MA and 41s quick, and potentially be in a down channel even as low as maybe back down to the recent lows of the 38s, 39s. But like I said, as long as this kind of holds 42.49, it's quote unquote okay. Speaking of stocks like that, Exxon is sort of sucking wind. Today was actually the last 2 days have been a bit of a breakdown. The key levels that we're going to come into in Exxon, and this is playing out kind of almost if I had my fantasy football league for stocks, Exxon is kind of playing into what I've been looking for to happen. I've been wanting this to pull down to get back into it on the channel low, which is roughly around 81. That's also a 61.8 fib of the entire range. I don't know if I'm going to get my druthers in that regard, but There is some key reference lows coming in around 81.99 to 83-ish, 83.01. I would probably, and this is what I will do, is likely start selling out of the money puts there with the intention that I do expect it to go lower. So I'll start with some smaller. I know everyone's going to say, oh, you don't add to losers. Yes, that is correct, but I am doing it consciously because I'm feeling for the bottom. Instead of buying my entire position size at 83, I'm going like smaller bits, like quarter, 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 feeling it out. That's a very different situation than starting a position wrong and, then saying, okay, I was wrong, but I'm going to still add. I am anticipating it to potentially go lower. So I'm doing it that way. I'm just redrawing this as a channel. People who watch my weekend reviews are going to get to see the new channel drawn. We're roughly below the 200 MA here. So yeah, any further down move into those 83s, I'm going to start selling the out of the money puts, and I'll be probably brought up to full size position closer to 81s if it does continue to go that far. So that's my Exxon play. With regard to the VIX, it got the backside of the old potential up channel line and the downtrend. It looked like a little bit of a look above and fail. It's currently holding the 200 MA, so you really need to see it back off below the 200 MA, which is below yesterday's low, which is 1583, for the market to gain legs. As long as the VIX is holding here above 1785s, it's possible that it re-sees the high from the other day, which was back up above, which was back to like 20 half. If it clears 20 half, there's another downtrend line roughly in the 23s, close to 24s, and it may even punch through to 25s. At that point, I would be looking to probably short some volatility because I don't necessarily know that this kind of spike is going to hold, and that's been some reference areas. But as of now, I'm going to keep it real simple. As long as we're holding over the 200 MA, we have to be cautious. Over 1785, still more cautious. Back below 1583, I would say that the fever is sort of broken in the spell. But that doesn't really seem to be likely ahead of the Fed. I think the people are going to be buying production and so on and so forth. I think the real play for the Fed might be to sell volatility, and I'll discuss that when we get to, we'll cross that bridge when we come to it. That was the VIX. Amazon, really choppy up here. It's right on the 50 MA. You have like 3 days worth of trade that held the 50 MA. If you lose 756s, I like a quick short down to 731s. If you can get back up above the 772.66, then I would think that this will likely revisit and make new all-time highs. So that's my story with Amazon. Netflix, it broke the downtrend. It's been like contained by the 200 MA. I like it over the 200 MA. I don't like it as much below the 200 MA. I think it's in a range. The range low is roughly 84s. The range high is roughly 101s to 103s. We're kind of toward the upper end, so I'm a little iffy about it. If you're long, you could use the 50 MA as a stop. Really, honestly, this stock doesn't have too many troubles until it breaks that area. The 92, 93 has been a very key level. I think it's just marking time and consolidating and probably waiting until their next earnings report. So if we're at the lower end of the range for the earnings report, I'd probably be more interested in a long, and if it's high, like it really like rallies and let's say like fills up to 108 or something before then, it may set up for a right or right out short, or a way to play that short. I want to end on this Wells Fargo. This could be one of the worst charts I've seen in quite some time. God, it looks like a head and shoulders, a failed check back, a trend break with a failed check back. As long as this thing is below the 200 MA, you don't want to be long this thing with someone else's money. I guess that was a PG version of kind of what I really wanted to say. But yeah, there's room down to the 44s. I don't know if that's going to even hold again. They have their litigation coming up. my guess is that they're going to have to kind of curtail their marketing, and it's probably going to hurt their quarter. Someone had messaged me and said, oh, they're going to save money on payrolls. That's true, but I would be a little careful with this. This stock looks like a big rolling time. I mean, you name the technical breakdown pattern, and I will, slap you high five. It is just... It's a rolling top, a head and shoulders, a failed check back, a break of trend, a failed check back of the break of trend, a failure on the 200 MA. I mean, the thing is just looking terribly to me. Yeah, Wells Fargo, I think, is likely going to see a little lower. I mean, a 50% fib from the all-time low to the all-time high is down in 33s. I know that sounds like a lot, but it really could happen. So be a little careful with the Wells Fargo. That's my take. Anyway, that's my story. I'm sticking to it. Yeah, so if you missed my previous broadcast or got cut out, I'm going to clip this together with that, and it will be on my YouTube channel at some point tonight. Alrighty, have a good rest of your day, rest of your week. You know the levels, we know the plan, and cheers.